something like 14%. So
unweighted is 30%, you said?
Yeah, 30%. Wow. It's insane.
I'd like to see the worst ones, the people that are dragging that average up. Yeah. But 14% is still an incredibly high number. And so you're saying that that's the average over the century or the past 100
over
years?
the past 60 years, 1960 to 2020. We get World Bank data on that, pretty reliable data on World Bank and European Union, OECD data. I ran the numbers on that, weighted average, something like 14%.
And what effect that has on time preference?
The effect is now it's much, much, much harder for everybody to provide for their future. Everywhere in the world, it's much harder. So how do I get the equivalent of the old gold coin that I could just put under my mattress and expect it to be there 10 years from now? Well, gold itself isn't cutting it. Gold can't keep up with inflation. And the reason for that is that gold is not being used as a money anymore, in that you can't send it internationally. You can't use it to settle trade internationally, which therefore means demand for it monetarily is limited. And so it's becoming more and more an industrial metal. And as a result of the fact that its value doesn't keep up with inflation, it becomes economical to use it in industry. So we're seeing gold become like silver in that it gets used in industry. So the stockpile declines. And so the stock to flow ratio declines as well. And it becomes more and more of an industrial metal. And it can't protect your wealth over time very well. So what do? Well, you could invest. And this is kind of the obvious answer that Keynesians will give you is, well, you just put your money in an investment. But investment is different from saving. Saving, the whole point of saving is that the thing is liquid and that the thing carries little uncertainty. You just held the gold coin and it just sat there. It did nothing. It didn't take risk. You knew that it was going to be there in 10 years. Investment means you give the gold coin to somebody to go and do something with it. Yeah. And it could work, it could not work. If it works, you get a positive return, you get more gold back. If it fails, you might not get any of your gold back. So taking on risk is something very different from saving. Saving is just a way of buying the future. Investing is taking on a risk, and you could lose everything with it. So what ends up happening, and this is, the Keynesian objection, I think, is absurd, is very wrong and bad, because investment is a job in itself. To figure out what to do with your money in order to beat inflation is something that, there are professionals out there on Wall Street that have PhDs in finance, that have enormous computers, and they have enormous staffs of PhDs and master's degrees and math nerds that are crunching numbers and figuring out how to allocate your portfolio so that you can beat inflation. And guess what? The majority of them don't beat inflation. The majority of them can't beat inflation, not as measured by CPI, which is completely fraudulent. But if you remember,
14%.
Yeah, that 14%, or even, the 7%. Like if you look at just the increase in the money supply, which I think is a much better metric. And this is what's reflected on the desirable goods. Like if you look at the price of real estate in Miami Beach, as Michael Saylor mentioned in your example, it goes up at around 6-7% per year on average over the last century. So that's, if you want to live in a nice area, that's what's happening to real estate. If you want to go to the good universities, that's what's going up. It's going up at a rate that's similar to the increase in the money supply. And you can beat CPI, but CPI is designed so you can beat it. But you can't really beat the appreciation in the things that you actually want to buy, in the price of good food, the price of good real estate. So most investment professionals fail at doing that. So what hope does a doctor or an engineer or a scientist or an athlete have in doing those things?
So investment is hard and saving should be easy.
Exactly. Saving is essential for us as a civilization. And what fiat did is it took that away from us, and then it forced everybody to become an investor, or more accurately, a gambler, because you're not just because the money itself is broken, because the money itself is constantly changing in value. Investing is becoming more of a crapshoot. I mean, value investing is completely underperforming compared to market analysis. You listen to the Fed, and what matters to the price of individual companies is monetary policy much more than it is their own performance. So basically, you need to be a junkie watching the Fed and following all of the world's central banks, and you need to learn macroeconomics, and you need to learn what all the central banks are doing, and you need to understand how commodity markets work, and you need to understand how equity markets work, and bond markets and real estate markets. You need to do all of those things just in order to be able to save and earn and keep the money that you've already earned.
Yeah.
That's the criminal thing about it. Like, I've already earned that money being a doctor, being a dentist, being an athlete, being an engineer. I built a house for somebody and I got that money. And all I want to do is just make sure that I can have it 10 years from now. The only way to do so is to become a crappy engineer, because you have to spend half your time not doing engineering and instead spend half of that time learning about Japanese central bank monetary policy and commodity markets and what's going to happen to copper and what's going to happen to oil and what's happening in the wars and what's happening with foreign policy and Russia and the US and all of those things. Under the gold standard, you didn't care about any of that stuff. Your gold coin worked regardless of all of those things. So what this means is the future. So first of all, we have all of the problems I mentioned, but also it means that the future becomes much more uncertain. So you're far less likely to provide for yourself 10 years from now, far less likely to find an easy way to give yourself value 10 years from now. And so you become more short-termist. And that is reflected economically in a lower savings rate, and we see savings rates decline. But it is also reflected in all manners of decision-making. And I think if you really want to see what it is, take a look at a society that goes through hyperinflation and look at what happens there. How do people change under hyperinflation? And compare that to essentially what we see in the 20th century all over under not hyperinflation, but under low inflation, 10, 15% that you see across the board most of the time is just slow motion hyperinflation. So what happens in hyperinflation? Everybody gets their paychecks. They run straight to the supermarket. They spend all of their money. Nobody thinks about savings. Nobody thinks about the future. Survival until the end of this month is highly uncertain. How likely are you to be planning for what you're going to be doing 5 years from now? Very unlikely. But also, it's reflected not just economically, it's also reflected in all aspects of morality, on all the way in which we deal with each other as human beings. When your survival is precarious, how much are you invested in the notion of being a good citizen, on caring about your reputation, on caring about not getting caught in a crime? All of these things become harder to value. So people start committing crime, people start caring less and less about the future. And we see it reflected in everything. And I argue you see it reflected in architecture. We used to build houses in the 19th century that last until today. And then in the 20th century, we build essentially disposable cardboard boxes that get scrapped in 20 years.
So what can you say about potential positive effects of lower time preferences? So, it's a balance. Like you're talking about an average kind of time preference, but, there's some things in life where low time preference can be a negative thing. So like if I want to take on risk, not for investment, or a kind of investment, but say I want to start a business, I want to take something crazy, take a leap into the unknown, be an entrepreneur. What can you say about that kind of leap? Taking on debt. What's the value of that within the current system? What's the right approach to that within the current system? What's the right approach overall from an economics perspective? So it's not saving for the future. It's doing something wild, taking the money from your mattress, taking on debt, and having a dream in your heart that you somehow just want to do. Maybe it's not the wisest investment decision, but it's something, it's being human. It's taking a leap into the unknown because something in your heart says to do it.
I think you're more likely to be taking the leap in the unknown when you have a little bit of gold in the mattress than when you don't. I think this is the thing. Like if you look at the late 19th century, and I discussed this in the Bitcoin Standard, that was arguably the most innovative period in human history. There's qualitative evidence. You look at the world around you today, pretty much everything that we use was invented in that period. The car, the airplane, the telegraph, the telephone, the camera, pretty much modern life as late 19th century, the period between 1870 and 1914, because the whole world was practically on a gold standard. The whole world was using the same money, and the whole world could save in the same currency. That meant that a bicycle shop owner, two bicycle shop owning brothers in North Carolina could go and try and fly, even as all the scientific experts in 1903 were confirming that the possibility of flight has been debunked as unscientific. Lord Kelvin said, not in a million years we're going to be flying. Thomas Edison said it's never going to happen. No, I think it was Edison who said a million years, but Kelvin also said it's never going to happen.
Yeah.
The New York Times said it's never going to happen the same month in which the Wright brothers did it. And they continued to deny that it happened even 2 years after they did it. But why could they do that? Because they had savings in gold. They had the security with something that is going to be there. And then you can take a risk with the stuff that is extra. I have, say, 3 years expenditures in gold under my mattress. And I know that I could take a risk with everything else, because whatever bad things happen with all of my dreams, like even, flying, think about how insane that is. I still can go back to the 3 years of gold that I have saved.
Still okay to take on debt, given the gold under the mattress?
Well, this is the thing. Under the gold standard, the way that people finance things was predominantly with capital, with equity. So because you had gold savings, I had gold savings, everybody had gold savings. When you wanted to start a business, you could use your own savings or somebody else's savings. So you didn't need to get into debt. You could get equity from others, and you could also get debt from others. So
but it's directly mapped to physical reality.
Yeah, it's directly back to economic reality, and that there's a hard money out there that, what you're spending money, you want to build your airplane factory. You need to get actual resources. So you get actual gold, either yours or somebody else's. You borrow it or you give them equity, but there's real resources. Now, what happened with the fiat system, and this is the first part of the book where I look at it from an engineering kind of perspective, is essentially, and I think this is like the breakthrough insight of the book, what fiat does is that it replaces gold mining with credit creation. The way that we make fiat money, the way that fiat is mined into existence, is through credit creation. Most people think of fiat money as being something that happens when government prints money. And we still use the term government's printing money. But the vast majority of fiat is not physical. And in fact, fiat is not created when it is printed physically. It's created when it is lent. So when you go to a bank to get a $1 million loan to buy a house, that bank is not going to give you $1 million from their own money or from their depositors' money. They're going to make a fresh new $1 million. When you walk out of that bank, the money supply has increased by $1 million to finance your home. So what fiat does is, it was basically born out of government credit and the credit of banks that are backed by the central bank and the government. So if you're part of the institutions that are allowed fiat privilege, where you can just issue loans backed by the central bank, backed by the currency, you are effectively creating new currency, new money every time you issue the loan.
That's fiat mining, is credit creation. I love it. So can you say something? You can't really have credit without a demand for credit. You can't really have an increase in supply without a demand for it. Is there any value you place in the humans wanting it? Basically, people wanting to do something with that credit, wanting to take big leaps, big risks, big entrepreneurial decisions. So is it all bad? Is all credit bad?
No, I think what's bad is, anything, in my opinion, anything that is consensual. I want to borrow money from you and we agree the terms. I can't object to that. As long as you and I both agree, I can't object to that. But in the case of the fiat system, it's not just you and the bank who come to an agreement. Everybody who uses the currency is forced to be part of that agreement, because if you default, effectively what's protecting the bank from you is the fact that the government can just print a bunch of money and make the bank whole. So effectively...
That's interesting. So that little agreement between the bank and you is actually an agreement between the bank, you, and the entire populace that's using the currency.
Exactly. They're forced to provide the safety net for you and me to go and make that loan. And that safety net is the devaluation of the currency. That's how the whole thing actually works. So this is why, I wrote the Bitcoin standard explaining Bitcoin, and then basically the takeaway message of the Bitcoin standard is you need to stack as much Bitcoin as you can, because this is the best money that has ever been invented.
And we'll talk about that, why Bitcoin is the hardest money.
Yeah. But with fiat, the conclusion of the fiat standard, and again, this is not financial advice. I'm a lowly academic. You shouldn't listen to me on issues of money. But I think theoretically and intellectually, the conclusion of the fiat system is you need to be short fiat as much as you can. That's the smart winning move. So human wisdom over thousands of years is to save, try and not borrow as much as you can, try and accumulate as much savings as you can. That's reversed under fiat. If you're saving money, you're just subsidizing everybody else taking on loans. If you're taking on loans, you're benefiting from all the people that are borrowing. So the winning move under the fiat system, and this is what rich people do, is you borrow. Rich people under the fiat monetary system, they don't hold assets. There isn't if you're worth $1 billion today, you don't have $1 billion in a checking account. You've got maybe 100,000, a million, 5 million or something like that. A tiny fraction of your money is held in cash. The majority is going to be held in all kinds of other hard assets. And you're going to be borrowing. The richest people in the world are the biggest borrowers in the world. The most powerful entities in the world, the governments, are the biggest borrowers in the world. And that's how they are the richest and the most powerful, because every time you're borrowing, you're giving the bank an excuse to print new money. So you're devaluing everybody else's money and you're getting a bit of the cut. If you're going to buy a house with your savings, you're accumulating the savings and they're losing value. And if I were to go to buy the same house with credit, I'm getting the bank to print money for me. So obviously they can cut me in on that deal. And that's why it's much cheaper for everybody to buy with credit. That's why everybody buys everything on credit.
So when we look at the global monetary system, the thing you want to do as a government is be the sexiest currency out there. So the main currency, like the dollar currently is the one that has the most power in that kind of context. So you have, if you were to try to summarize what is the global monetary system as it is today, is a bunch of fiat currencies battling for position, for use outside their nation, and in so doing trying to gain power in the geopolitical sense. Is that, if we just zoom out, what is the global monetary system like? What is it currently? So outside the United States, the whole thing.
Yeah, you could say that, but I think it's more realistic looking at how it has actually evolved over the past few decades. It's really a dollar system. It's not a system of currencies vying with one another. It's a dollar system, and all other currencies are just basically, I like to call them dollar plus country risk. So
it always returns home to the dollar.
Yeah, there is no competition. There is no second best, as Michael Saylor would say. And money is like that. Gold was a winner-take-all by the end of the 19th century. The global monetary market is effectively a winner-take-all for the dollar. And if we get into Bitcoin, you'll know I also think digital currencies are also going to be a winner-take-all situation. So money wants to be one. In fact, there is no such a thing as multiple currencies. Multiple currencies is just a step back to barter. Money is one. If you go back to a system of several currencies, you're just reinventing barter. So in the case of the dollar system, the global dollar system is built around the dollar, because all central banks have dollar reserves, and because all central banks use the dollar's clearing mechanisms. So that's why you're basically playing in the dollar system. This seems to have changed over the last couple of months with the sanctions on Russia and the confiscation of Russian reserves. It remains to be seen what that's going to do and how that's going to change. But it is looking like, this dollar system is clearly unsustainable. It's not sustainable for the US. It's not sustainable for anybody.